Ever wondered how parent companies navigate reporting their investments in other entities? Welcome to the world of consolidation basics in Accounting 101 Financial Reporting. Here, we unravel the intricacies of how these financial relationships are showcased. Picture this, a web of interconnected entities, each with its own story to tell. From subsidiaries to associates, understanding these dynamics is key to a robust financial picture. Stay tuned as we delve into the nuances of consolidation, shedding light on the foundation of financial reporting. Let's demystify the complexities together. Welcome to today's presentation on the fundamental concept of consolidation in financial reporting. Are you ready to dive into the essential building blocks of preparing consolidated financial statements? Let's start by exploring how to categorize subsidiaries, associates, and joint ventures based on ownership and control. Next, we'll unravel the process of determining whether a parent company controls another entity. Then, we'll delve into mastering elimination entries, goodwill calculation, and non-controlling interest in consolidation mechanics. Finally, we'll apply these concepts through examples and challenge your understanding with a quiz. Get ready to solidify your knowledge in financial reporting and enhance your accounting skills. Remember, understanding consolidation is key to your success in the accounting world. Why does consolidation matter in the corporate world? When one company exerts control over others, it's crucial for investors to grasp the full financial landscape encompassing the entire group, not just the parent company in isolation. In practical terms, many large corporations own multiple entities, making consolidated statements essential to prevent concealing liabilities within subsidiaries. This practice isn't just a suggestion, it's mandated by accounting standards such as US GAAP and IFRS. Ultimately, providing consolidated financial information is critical for informed investor decision-making. So, why does this matter? It ensures transparency, minimizes risks of obscured financial details, and empowers stakeholders to make well-informed choices. Ever wondered how companies strategically allocate their resources? When it comes to investments, there are three key categories to understand. The level of ownership and influence plays a crucial role in how these investments are managed. Let's delve into these three types to gain insight into how companies navigate the world of investments. Ever wondered how investments are classified in the financial world? Let's delve into the three main types: subsidiary, associate, and joint venture. When a company holds over 50% ownership in another, it's a subsidiary, leading to full consolidation in financial statements. Associates, with 20 to 50% ownership, involve equity method accounting for profit sharing. Joint ventures, with shared control, see each party using the equity method for accounting. Each classification brings unique financial implications and strategic considerations. In the complex world of investments, understanding these distinctions is key to making informed decisions. Did you know that ownership percentage isn't the sole factor in determining control and influence? To truly assess ownership thresholds, we need to consider a mix of quantitative and qualitative factors. It's not just about the numbers, it's about the impact they have. When examining ownership thresholds, keep in mind that control and influence are multifaceted. It's not enough to simply look at the percentage owned, we need to delve deeper into the nuances of ownership dynamics. By understanding the interplay between various factors, we can gain a comprehensive view of ownership thresholds. So, next time you're evaluating ownership stakes, remember, it's not just about the numbers on paper. It's about the intricate web of control and influence that truly defines ownership thresholds. Ever wondered how control sets the stage for consolidation in business? It's more than just owning shares. Control involves wielding power over the investee, steering activities that impact returns through voting rights. The exposure to variable returns adds another layer, fluctuating with the investee's performance. And crucially, having the ability to use power actively directs activities to influence the returns gained. Control isn't static, it's about actively shaping outcomes. In the world of assessing control, a decision framework guides us. Does the investor hold power over the investee? Are they exposed to variable returns? Can this power influence those returns? If all these elements align, control exists, and consolidation is necessary. Remember, all three must be present simultaneously for control to be recognized. It's a trifecta of power, exposure, and influence. And when that trifecta hits, it's time to consolidate. Ever wondered how corporate entities fit together like puzzle pieces in a group structure? Understanding these relationships is key to determining which entities to consolidate. Picture a complex network of divisions, subsidiaries, and affiliates, each with its own role and function within the larger organization. This intricate web of interconnected entities forms the backbone of a company's operations and strategic decision-making. As we delve deeper into this example, we'll uncover the importance of clarity and precision in identifying the right entities for consolidation. So, let's unravel the layers of this corporate puzzle and discover the strategic significance of group structures. Ever wondered how ownership percentages impact financial reporting within a corporate group? Let's delve into the intriguing dynamics of sample corporate group. Here, Parent Corp holds varying stakes in 4 entities, leading to diverse classifications for financial reporting. Despite owning just 80% of subsidiary A, Parent Corp exercises full control, resulting in complete consolidation. The remaining 20% stake is recognized as non-controlling interest. This nuanced approach ensures accurate representation of each entity's financial standing. Ownership levels, control assessments, and reporting distinctions all play a pivotal role in painting a comprehensive financial picture within corporate structures. In essence, understanding these intricacies is key to transparent and informative financial reporting practices. Have you ever wondered why elimination entries are crucial in financial consolidation? When combining parent and subsidiary statements, we encounter duplications and artificial transactions that need to be removed to present the group as a unified economic entity. Why eliminate? Internal transactions between group members lack external validity, leading to potential overstatement of assets, liabilities, revenues, and expenses. Common eliminations include adjusting the investment in a subsidiary versus the subsidiary's equity, intercompany sales, purchases, receivables, payables, and unrealized profits on inventory transfers. The key principle is to showcase only external transactions, treating internal group dealings as if the group operates as one cohesive entity. Remember, clarity in financial reporting necessitates eliminating intercompany transactions to accurately reflect the group's financial position. Ever wondered how to tackle the duplication issue in consolidation entries? Picture this: Parent Corp acquires Sub Inc. for $800,000, with both showing the same equity value. The solution? Eliminate both the investment and subsidiary equity accounts. A strategic entry of $500,000 to common stock and $300,000 to retained earnings eliminates the $800,000 duplication. Consolidated balance sheet? Clean and clear, showcasing only the parent's equity. Simplify, strategize, and eliminate for a streamlined financial picture. Ever wondered about the concept of goodwill in business acquisitions? When a parent company pays above the fair value for a subsidiary's net assets, that excess amount is known as goodwill. Think of it as the intangible essence that encompasses reputation, customer connections, and synergistic opportunities. Goodwill goes beyond tangible assets, embodying the essence of what makes a business unique and valuable. It's like the secret sauce that sets a company apart from the competition. So, the next time you see a high purchase price for a company, remember that a significant portion of that could be attributed to goodwill. It's the intangible magic that can drive business success. Why does goodwill matter in business acquisitions? It captures the value above and beyond assets acquired. Imagine this: the parent company pays $1 million for Sub, with its net assets valued at $850,000. The difference? $150,000 in goodwill. Remember, goodwill isn't amortized but monitored for impairment annually. If Sub's value drops, goodwill might need adjustment. Goodwill, an essential, non-depreciating asset that reflects acquisition value. Ever wondered how goodwill impacts consolidation entries? Well, when goodwill is in play, our consolidation entry gets a strategic twist. Let's dive into a scenario. Parent snags 100% of Sub for $1 million, with subs equity at $800,000 and assets undervalued by $50,000. The fair value of net assets lands at $850,000, leaving us with goodwill of $150,000. To adjust, we debit common stock by $500,000, retained earnings by $300,000, assets by $50,000, and add $150,000 for goodwill, offset by a credit of $1 million for the investment in sub. This move eliminates the investment, acknowledges the fair value adjustments, and embraces the goodwill. In short, recognizing goodwill in consolidation entries is key to capturing the full financial picture. Ever wondered about NCI in financial statements? Non-controlling interest, or NCI, is the stake in a subsidiary not owned by the parent company. Even though we consolidate the subsidiary, outside shareholders have a claim. NCI is showcased in two key places: as a distinct part of equity on the consolidated balance sheet and as a deduction in the consolidated income statement. This transparency is vital, revealing exactly how much of the consolidated entity belongs to the parent versus external parties. Understanding NCI is crucial for a precise analysis of the parent company's economic standing and performance. So, when you see NCI, remember, it's about clarity, ownership, and financial truth. Ever wondered how non-controlling interest is calculated in consolidating financial statements? It's a simple yet crucial process. Take a scenario where the parent company owns 80% of a subsidiary with $500,000 equity and $100,000 net income. The non-controlling interest in net assets amounts to $100,000 and in net income, it's $20,000. By deducting this NCI portion from the total net income, we arrive at the income attributable to the parent shareholders. This calculation ensures a fair reflection of each party's stake in the consolidated entity. Remember, in financial reporting, every detail counts. Ever wondered how to navigate the complexities of consolidation with non-controlling interests? Let's dive into a scenario where a parent acquires 80% of a subsidiary for $720,000. With fair value adjustments and goodwill in play, the puzzle starts to take shape. As we calculate the goodwill attributable to the parent, remember, it's all about aligning the figures just right. The elimination entry dance involves adjusting common stock, retained earnings, assets, and goodwill, creating a symphony of financial harmony. And don't forget the non-controlling interest factor, a crucial piece in the consolidation puzzle. So, when all the numbers settle, the key takeaway is clear: precise calculations and strategic entries ensure a seamless financial landscape. Ever wondered about the key pillars of consolidation in accounting? Let's dive into the essentials. Classification is key: subsidiaries consolidate, associates apply the equity method, and joint ventures share control. Remember, control hinges on power, variable returns, and the ability to utilize that power effectively. To streamline, eliminate duplications by offsetting the investment account and intercompany transactions. Oh, and don't forget goodwill. It's the sweet spot between the purchase price and net assets fair value. Lastly, show NCI separately to give minority shareholders their due recognition. These concepts are your stepping stones to mastering advanced consolidation topics. Let's put your knowledge to the test with these consolidation scenarios. 1. Parent owns 45% of entity X with significant influence. How to account for this? Use the equity method, associate. 2. If parent pays $600,000 for 100% of sub with net assets at fair value of $550,000, what's the goodwill? It's $50,000, $600,000 to $550,000. 3. Parent holds 70% of sub, reporting net income of $200,000. What's the NCI in net income? It's $60,000, 30% x $200,000. 4. True or false, in consolidation, do we add 100% of the subsidiary's assets even if we own only 80%? True. We consolidate 100% and show NCI separately. 5. What's needed to establish control? Power over investee, exposure to variable returns, and the ability to use power to affect returns. Remember, grasp these concepts well to excel in financial consolidation.